There is a one-word difference between the strategies in this video and a federal indictment, and that word is legally. Tax avoidance is the deliberate use of the tax code's own provisions to reduce what you owe. Tax evasion is lying about income or assets to reduce what you owe. The IRS itself draws this line repeatedly in its own published guidance, and every structure described here exists in public filings, court precedent, and tax code sections anyone can read. The wealthy do not have access to secret rules. They have access to expensive people who read the same public rules more carefully than most. Level 1. The single entity. Most small business owners operate as a sole proprietorship or a single-member LLC, and at this level, the tax code treats the business and the owner as essentially the same taxpayer. Every dollar of profit flows directly onto a personal return and gets taxed at ordinary income rates, the same rates that apply to wages. There is no holding company here, no structure, nothing standing between the business and the owner's personal tax exposure. This is the floor everyone starts from, and it is also where the legal tax reduction toolkit begins, even without a holding company in sight. The first tools available at this level are unglamorous and underused. The qualified business income deduction, which allows many pass-through business owners to deduct up to 20% of qualified business income before calculating tax, exists specifically because Congress wanted pass-through entities to receive treatment closer to what corporations get under a lower corporate rate. Retirement contributions through a solo 401k or SEP IRA reduce taxable income today, while deferring the tax to retirement when income and the corresponding tax rate are often lower. None of this requires a holding company. It requires knowing the deduction exists and a CPA who actually applies it instead of taking the standard deduction by default, because it is faster to file. Level 2, the operating entity gets its own tax identity. The first real structural decision happens when a business owner elects S corporation status for an existing LLC or forms a C corporation outright. An S corp does not pay corporate tax itself. Profit passes through to the owner's personal return, same as the sole proprietorship. But it creates a critical distinction the IRS cares about: a reasonable salary subject to payroll tax, and a separate distribution of remaining profit, which is not subject to the 15.3% self-employment tax that applies to sole proprietorship income. This single structural choice, properly executed, saves a profitable small business owner real money every year, and it is entirely legal, provided the salary is actually reasonable for the work performed. A standard the IRS audits specifically because owners historically set the salary number suspiciously low to maximize the distribution and minimize payroll tax. A business owner clearing $300,000 in profit who pays themselves a $60,000 salary because a forum post said that was the move, discovers, usually during an audit triggered by exactly this pattern, that reasonable compensation is not whatever number minimizes tax. It is a defensible number based on what the role would cost to fill with someone else, documented and ready to be defended if the IRS asks. The documentation itself matters more than most first-time S-Corp owners realize. A reasonable compensation determination that holds up under audit typically references comparable salary data for the specific role and industry, accounts for the hours actually worked, and gets revisited annually rather than set once and forgotten. Tax professionals who specialize in this area maintain files specifically built to survive scrutiny. Not because the client is likely to be audited, but because the cost of building the file properly the first time is a fraction of the cost of reconstructing a defense after an audit notice arrives. This is the pattern that repeats at every level of this structure. The legal version of the strategy and the audit-proof version of the strategy are usually the same amount of extra effort, applied at the beginning instead of after a problem appears. A C corporation introduces a different mechanism entirely. The corporation pays its own tax, currently at a flat 21% federal rate, separate from the owner's personal return. This creates the famous double taxation concern. Profit taxed at the corporate level, then taxed again if distributed to the owner as a dividend. But it also creates planning opportunities a pass-through entity does not have, particularly around retained earnings, fringe benefits paid by the corporation rather than the individual, and the foundation for everything that comes at the next level. Level 3. The holding company appears. This is where the structure in the title actually begins. A holding company is, at its simplest, an entity that owns equity in other entities rather than operating a business directly. It does not sell a product or provide a service. It owns the company or companies that do. The operating business sits below it, generating revenue and profit. The holding company sits above, owning the equity, and increasingly, owning the assets the operating business would otherwise hold directly. Intellectual property, real estate, equipment leased back to the operating entity for a fee. The tax mechanism that makes this structure valuable is not exotic. It is the deduction for the lease or licensing payment the operating company pays to the holding company, which reduces the operating company's taxable income, combined with the ability to structure how and when that income reaches the ultimate owner. A holding company that owns the trademark and brand IP of a restaurant chain, for instance, can license that IP back to each individual restaurant location at a royalty rate, which is a deductible expense for each restaurant, and income to the holding company, income that can then be retained, reinvested, or distributed according to a plan that is far more flexible than profit trapped inside a single operating entity. This is also the level where liability and tax planning start to overlap. An operating business that gets sued does not expose the holding company's assets if the structure is maintained correctly. The same liability containment principle that drives real estate investors toward LLC stacks applies here. Except the holding company adds a tax dimension, the simple LLC stack does not. The mistake that recurs most often at this exact level is structural, not malicious. A business owner forms the holding company correctly, transfers the IP and equipment as intended, and then 18 months later lets the royalty payments lapse during a slow quarter because cash is tight and the intercompany invoice feels optional when it is, functionally, money moving between accounts the same person controls. The IRS does not see it that way. An intercompany charge that exists on paper but does not actually get paid, documented, and treated as a real transaction is exactly the kind of inconsistency that converts a defensible structure into one an examiner can argue was never genuinely operated as designed. The holding company has to actually function as a separate economic entity, invoices issued, payments made, books that would make sense to a stranger reading them, or the tax benefits attached to the structure become vulnerable to exactly the same challenge. Level 4. Multiple subsidiaries under one holding structure. As the business grows, or as the owner acquires additional businesses, the holding company begins owning multiple operating subsidiaries rather than one. This is where intercompany transactions become a genuine area of tax planning rather than a side effect. Management fees charged by the holding company to each subsidiary for services like accounting, legal coordination, and executive oversight are deductible at the subsidiary level and become income at the holding level, where the owner has more control over timing, reinvestment, and which entity ultimately bears the tax liability in a given year. This level introduces a real and well-documented technique, income shifting between entities with different effective tax positions. If one subsidiary is generating strong profit and another is in a growth phase generating losses, a properly structured holding arrangement can, within real legal limits, allow strategic timing of distributions and intercompany charges that smooths the overall tax picture across the group, rather than letting one profitable entity pay maximum tax while a related entity's losses sit unused. This is not the aggressive abusive transfer pricing that triggers IRS scrutiny and the kind of penalty cases that make financial news. Those cases typically involve pricing intercompany transactions in ways that do not reflect what an unrelated third party would actually charge, the arm's length standard the IRS enforces specifically to prevent exactly this abuse. The legal version of this technique stays close to defensible market rates and documents the reasoning for every intercompany charge because the IRS's transfer pricing rules exist precisely to police the line between this level and the kind of structuring that becomes a federal case. Subscribe before the next level. because this is where the structures most people picture when they hear corporate tax avoidance actually begin, and where the line between legal and illegal becomes the entire subject. The next section is on screen in 90 seconds. Level 5. Jurisdictional structuring. At a certain scale, the holding company's own location starts to matter as much as what it owns. States like Delaware, Nevada, and Wyoming offer favorable treatment for holding companies specifically. No state corporate income tax on companies that do not operate within the state. Strong asset protection statutes, and a well-developed body of business law that makes disputes more predictable. A holding company incorporated in Delaware that owns operating subsidiaries doing business in California still pays California's taxes on the income earned in California. Incorporation location does not exempt a business from taxes where it actually operates, but it can meaningfully reduce the tax burden on income generated by the holding company's own activities, like investment income or licensing revenue not tied to a specific operating state. International structuring is where this conversation becomes both most powerful and most heavily regulated. Holding companies in jurisdictions with favorable tax treaties, lower corporate rates, or specific incentive regimes for intellectual property and holding activities have been used by multinational corporations for decades to legally reduce effective tax rates. The well-publicized strategies that allowed some large technology and pharmaceutical companies to report effective tax rates in the low single digits made global headlines, specifically because they were legal, aggressive, and used the actual letter of international tax treaties as written. Congress and international bodies have spent the years since closing many of these specific mechanisms. Base erosion rules, global minimum tax frameworks adopted by more than 140 countries through the OECD process. Precisely because the gap between legal, aggressive structuring and the spirit of the tax code had grown wide enough to become a genuine policy problem, not a conspiracy, a documented and debated one, fought out in legislation rather than in secret. This is the level where the gap between what was legal yesterday and what is legal today moves fastest, and it is worth being specific about why. A structure that a major multinational used in 2015 to shift intellectual property income to a low-tax jurisdiction with minimal economic substance there, meaning few employees, little actual activity, mostly a mailbox and a holding entity, exploited a real gap in how international tax treaties defined where income was earned. The global minimum tax framework and the economic substance requirements most major jurisdictions adopted afterward closed that specific gap by requiring holding entities to demonstrate genuine business activity in the jurisdiction claiming the tax benefit, not just a registered address. The strategies that made headlines a decade ago are, in their original form, largely no longer available. What remains legal has narrowed considerably, and the families and corporations still using international holding structures today are operating inside a meaningfully tighter set of rules than the ones that generated the most famous examples. Level 6. The Family Office Tax Architecture. At the highest level, holding company structures stop being purely about operating businesses and start incorporating the full estate and generational planning apparatus. A holding company can own interests not just in operating businesses, but in investment portfolios, real estate, and increasingly, interests held inside irrevocable trusts designed specifically to remove appreciating assets from a taxable estate while the original owner is still alive. The combination of a holding company structure with a properly funded grant or trust allows a family to freeze the value of an asset for estate tax purposes at today's value, while all future appreciation happens inside a structure that, by design, falls outside the eventual estate tax calculation entirely. This is also where charitable structures enter the tax planning conversation, not from pure generosity, but as a documented, intentional tool. A donor-advised fund or private foundation funded with appreciated holding company stock allows a family to take an immediate tax deduction for the fair market value of the donated shares, avoid the capital gains tax that would have applied if the shares were sold first and the cash donated instead, and maintain meaningful control over how and when the charitable funds are eventually deployed. None of this is secret. The IRS publishes detailed rules governing exactly how much can be deducted, over what time frame, and what level of control a donor can retain, without triggering rules designed to prevent the charitable deduction from becoming a disguised personal benefit. What every level actually has in common. Strip away the complexity, and every level of this structure rests on the same legal principle. The tax code is not a flat tax on existence. It is a long, specific, heavily negotiated set of rules about which activities, structures, and timing decisions Congress has chosen to tax differently. And the people who pay the least relative tax are not breaking those rules. They are reading them more carefully, structuring their affairs to fit inside provisions that already exist, and paying the professionals required to do that correctly rather than guessing. This is also where the gap between legal and illegal becomes the entire story. Every technique described in this video has an evil twin. The legal version stays close to market rates, documents its reasoning, and survives an audit. The illegal version cuts the same corner without documentation, prices intercompany transactions at numbers nobody could defend to an examiner, or simply hides income rather than legally repositioning it. The IRS's transfer pricing division, its passive foreign investment company rules, its reasonable compensation audits, all of it exists specifically to police that line, and the cases that end in criminal prosecution overwhelmingly involve someone who crossed from aggressive but legal into simply not reporting something that happened. When the structure costs more than it saves, the professionals who build these structures correctly are not magicians, and they are not cheap. And the second fact explains a real limitation worth naming. Honestly, the cost of building and maintaining a properly documented multi-entity holding structure, the legal fees, the annual filings, the transfer pricing studies, the CPA hours required to keep every intercompany transaction defensible, only makes financial sense once the tax savings clearly exceed the cost of the structure itself. This is why these techniques cluster the way they do, appearing more often as profit and complexity increase. Not because smaller businesses are forbidden from using them, but because a $40,000 annual structuring cost applied against $15,000 in potential tax savings is not a strategy. It is an expensive mistake, wearing the same clothes as a sophisticated one. None of this requires a holding company to apply at a smaller scale. The principle underneath all 6 levels: separate the activities, document the reasoning, use the provisions Congress actually wrote, works whether you're running a single LLC or a 6-entity holding structure. The complexity scales with the money. The principle does not change at all. The next video goes inside an actual transfer pricing dispute. A mid-sized holding company that priced an intercompany licensing fee at a number the IRS rejected as unreasonably low, the audit that followed, the $1.4 million adjustment, and the specific documentation that would have prevented the entire dispute if it had existed before the IRS came asking instead of after. The exact line between aggressive and illegal examined from the inside of an actual case. That conversation starts now.